All right. Class is rolling. The recording is rolling. Appreciate everybody who had joined here on a Thursday night. As most of you know, our Thursday streams are a little bit more geared to the psychological side, the mental side of trading. But today, as I was saying before, I kind of want to bring both of those together to show you guys how I have been manipulated through the psychological mentality aspect of it, as well as through the charts. We're going to kind of both bring those together today to figure out how we get manipulated out of trades and to start to get into trades to where we can put stop losses underneath protected lows and protected highs versus lows that are going to get taken out or highs that are going to get taken out. So we're going to talk a lot today about liquidity, how it works, why it makes sense, and why it's used in institutional analysis greatly. Dojang was saying it looks simple sometimes, but very not simple as well. That's exactly the truth of how it works. Liquidity, to make it as simple as possible, is what makes the market move. If there was no liquidity, the market would not move. It would only go up one way forever or down one way forever. And the reason I say this is because liquidity, supply and demand, the money, is what moves the market, meaning if there was not supply and demand available within the market, then as I was saying before, it would go up forever or it would go down forever. So just before we get into this right here, I want to kind of bring this down and we'll talk about what liquidity means. So I'm just going to make up a fake little graph here. We'll pretend these numbers are the price of an apple, right? Meaning I'm just going to draw out a fib retracement. This is a premium and discount price of an apple. Let's say down here, the price is $1. We'll put it right here. So the price is roughly $1 right here. And then above, it's $2, okay? So we'll put $2 up here as well. This is just to get a basic understanding of why the market moves the way it does in the form of candlesticks. All right, so let's just pretend $1 here, $2 here. This is the price of an apple, okay? The starting price is $1.50. So we'll start it out at $1.50. Now let's say the amount of apples that you have available goes down, which means there's more demand for apples, which means the price is going to rise. So as the price rises with the demand of the apples, us as institutional traders want to buy the cheap price. And the reason we want to buy the cheap price is the same as the algorithms. The algorithms and the institutions are very greedy as far as taking liquidity in the market. So we'll get to that point when we start getting into the liquidity concepts, but right now we're just focusing on this. But the price of the apple goes up to $2 as you have less apples, and then all of a sudden you get a new supply of apples. You get a bunch of new apples in, and now all of a sudden it's overstocked, right? And you're scrambling to sell your apples, so now you have to lower the price. So you lower the price of the apple, and it starts to go down. Now algorithms and institutions are looking to buy this apple. They're looking to buy the apple as it's in discount, as it's cheap to them, and as the liquidity is opening up within the market. We will also get into that as well. But they are looking to buy the apple. They buy the apple, and then they start, now that there's more demand within the apples, you see price rise. So now price begins its rise again. And it's just a battle between premium and discount as far as how the charts move, how they present themselves, and how it actually shows it to you on the screen. So that was just a little quick understanding of why the price moves the way it does based off of supply and demand. And now we're going to get into the liquidity concepts from both a retail perspective and an institutional perspective as well. So getting rid of this here. Let's go back to our little graph that we had up here. Liquidity, what does it mean? And then on the left over here, I have retail, quote unquote, uninformed. And then on the right, I have institutional, quote unquote, informed. So liquidity, we talked about what it means to the market, why it's important to the market. Now let's talk about the technical aspect of it. So how is liquidity shown in candlesticks? How can we mark that out as yes, that's real, or yes, that isn't real? I'm sure a lot of you traders, when you first got into this game, were shown support and resistance, right? So you have price coming up, maybe it makes a double top or a triple top, and then price starts to come down, and you have this area where you're told this is resistance. Now, support and resistance can work. This is just a show for liquidity based on how the institutions are going to take liquidity, right? So it comes up, you have this area that looks like resistance. So what is the uninformed liquidity retail doing? Because it's reacting off of their box. They're looking to short this to the downside, and they're putting their stop losses over that resistance. So they're going to have their area of resistance and then an area of support. Maybe it's down here. An area of resistance, area of support. They're looking to just trade back and forth through that support and resistance, putting their stop losses over the support, putting their, resistance and stop losses below the support if they were long. So we can do something just like this, looking like a long, trying to take it to the resistance or take it higher, whatever it is. But the point of this is because they have their stop losses over these highs right here, that leaves a high value area of liquidity, meaning when we see price do something like this and break out to the upside, they believe it's a breakout, so they're going to look to buy as well as they have just been stopped out. What getting stopped out does is open liquidity in the market as well as those who are playing breakouts, meaning they have a long position at the top of their zone with stop losses below that they look to trigger once price breaks out to the upside, so they can catch that move to the upside, right? And then you see something like this where price comes up, it opens up all that liquidity in the market in the form of these stop losses, and then you see manipulation, and then you see something like this occur. And now all of a sudden retail is like, what is happening? Why was I getting stopped out of my trades? When the whole point of this scheme was to distribute lower after opening up liquidity into the market. So now that they have taken out liquidity here, and let's just put this out visually for you guys. Make this 12, take off the border, and put down liquidity. All right, now that we have all this money opened up within the market, the algorithms and institutions now have the ability to stack orders. So now that they can stack their orders with more money because they are greedy, they want to make the most possible. Now that that liquidity is opened up within the market, then you wait for the break of structure with displacement, meaning that's what the algorithms are showing you. They're showing their hand. We can wait for the double break of market structure with displacement, and we can look for that area of supply shown from the institutions and the algorithms to short to the downside instead of looking to buy on a breakout to the upside. So retail sees this as a breakout. They're all looking to take this to the upside. Institutional sees this as a distribution scheme, meaning it's leaving those highs, manipulating lows, and then it manipulates the highs, starts to leave lows, and we now have trendline liquidity. Again, retail trying to buy, taking this to the upside in the form of stop losses. So now that they have been taken out of their trades here in these shorts, they're like, I'm going to go ahead and buy now because I've been disproved. They buy, they put their stop losses underneath these lows, and these lows, and the liquidity that's available is now the reason that price distributes to the downside. So that's how the market moves and why they are manipulated from a retail perspective. We show bull flags as well. I can go ahead and draw one out. Bull flags, bear flags, whatever you want to call them, right? You see something like this happen. Price starts to bounce off of these lines. And from a retail perspective, they're trying to hold the lines, right? They're saying that price is going to react off of my rectangle because I placed a rectangle on the screen. When instead of trying to figure out why the candlesticks are moving and look at the footprints that they are giving to you, they are saying just because my box is there or just because my line is there, it's going to bounce off of that and it's going to go up or go down. So they look to buy or sell based off of that. Now, with these scenarios like this, we see something like this happen. Then we get a breakout and continuation to the upside. Within this certain move right here, we'll show the institutional perspective in just a second. But from a retail perspective, again, they are buying the lows, putting their stops underneath the flag or the lows, whatever it is, because they don't want to be wrong, just buying, 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 and then they are selling, 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 selling. So you now have liquidity on both sides. And actually, I'll just use this one over here. Right? You have liquidity right here as well as liquidity right here. How this works from an institutional perspective is which side is manipulated. We're going to sit there and ask which side is manipulated, how does that work, and how can I look to get into a trade? So whenever I say it's leaving highs or leaving lows, I'm saying it's leaving highs in the form of that retail stop losses, meaning in this bull flag scenario, as they're buying the lows, buying the lows, buying the lows, buying the lows, once they get taken out, what are they going to do? They see a breakdown, so they're going to short. They're going to short it to the downside, and now all that liquidity has shifted, right? And we'll clone it to the short side instead of the long side because now it's been taken out of the market. So now the algorithms can enter their long positions. And also if we use this from a premium and discount perspective, we can look at it like this. Price comes back into discount, manipulates the lows, and then breaks structure to the upside from a lower high to a higher high. And now we have our available area of demand we can look to take this trade on. When overall, this looks like a higher high, and we'll draw it out like this. Higher high, higher low, continuation to the upside as far as this move. So utilizing this area of liquidity, these areas of liquidity is going to be very, very, very important. Whenever I talk about how we can spot them, it's going to simply be in the form of equal highs or equal lows. This can be trendline liquidity. This can be literal equal highs like this or literal equal lows like this. But we have these scenarios where liquidity is opened up in the market. And the reason why it's opened up in the market is for the availability of new demand or new supply. So now let's talk about it from an institutional perspective. Let's draw out this same exact scenario that had happened right here and talk about it from that institutional perspective. Price comes down, price comes up, then makes its move to the downside and distributes. And then let's draw out this one as well. Price comes up, it's in its flag, starts to make its move down, and then makes a move higher. Okay, so with this one over here, from an institutional perspective, we have our premium and discount. So we'll draw it from this low to this high right here. Apologies, this one right here. Premium and discount. And then we can draw the premium and discount with here as well. Remember, algorithms and institutions want to buy discount and they want to sell premium. When it's expensive to them, they look to sell. When it's cheap to them, they look to buy. And we can use market structure as well as the Fibonacci, premium and discount. I use the 50%. If anyone wanted to see the settings, I'll just show them real quick. But it's literally just the 0, the 1, and the 0.5 just to figure out my premium and discount for that certain range or that certain swing move. But from an institutional perspective, notice how we maintain premium most of the time on this scheme right here, meaning it's expensive most of the time. And once we have that first move down, this gets everybody into shorts, the early shorts. And then once those early shorts are taken out, it opens up liquidity into the market. It's also in premium still. We see the break of structure to the downside with displacement, meaning it's a large candle, very obvious candle that leaves an imbalance behind. We'll talk about that as well. And then we get that market structure shift showing us from bullish to then bearish. So now we have that area of supply. With the new introduction, we can look to short on and take it to the downside, targeting equal lows, targeting liquidity with the institutions. Dojang is asking why equal highs equal lows. Lines are important on a liquidity perspective because retail traders false behavior. Smart money use this on the opposite side. Yes, the reason I talk about the equal highs and the equal lows, why are they important, is for the introduction of new demand or new supply. So if you have an old zone, and let's just talk about something like this. Let's say price makes an up move, and then it starts to come back down, and you're looking to buy on this zone right here, right? Overall, we're bullish. as long as we maintain this low that caused this high right here. And I'll go ahead and draw that out. So overall, we are still bullish, but we have a form of equal lows right here within discount, and we may have a demand zone as well down here that had started an impulse from the move before. But let's talk about the early shorts and the early longs. Once retail gets a move like this, they see a clean area that they want to buy off of and continuously take it higher. Because remember when we first started this out as well, how we said the market does not move like this? And instead the market moves with accumulations to then reaccumulations to then distributions to redistributions, and more of this erratic behavior over just clean higher highs, higher lows, higher highs, higher lows. And why? Because that would be simple. How many times, and I say this a lot, for the 90%, have it been simple enough for somebody to go onto Google and look up support and resistance, or look up a bull flag, and then decide they can go trade off of that based off of what they've been advertised, right? They see somebody online making $5,000 in 5 minutes with a bull flag, and they're like, that's really simple. I should be able to do that too, right? But the algorithms and the institutions are trying to manipulate you out of those positions. So you must understand that from the algorithmic perspective, they are against the uninformed liquidity. They are against retail. So we look for the equal highs and the equal lows to look for the new introduction of demand or supply. Meaning, on this move to the upside right here, retail may see a very clean zone and call it a support, right? And they want to buy off of this zone. And you see price come in, limit orders are triggered, and you see a move off of it. And now all of a sudden retail starts to get happy, and they're like, yes, I want to take this to the upside, or I'm good, I can hold this, maybe hold it to this high, or continue to take it to the upside. But then they get a situation like this, where it goes lower. And then following that, and I actually can't draw it to the right anymore, but following that, you get a move to the upside. And now price makes that move to the upside after it's taken out the early longs. This is the early long liquidity that are trying to long this and take this to the upside. I have no idea why it's super small. But they're trying to long this and take this to the upside. And from that, I don't even want to worry about that right now. But from that, they put their stop losses underneath these lows, this low right here, and then maybe even lows down here. And the reasoning from that is price comes up, mitigates or takes out the early shorts right here, and then it starts to make its move down into discount. And now that it's in discount, we're looking to buy once that structure shifts from lower lows to lower highs. So there's situations like this where retail's trying to buy that support or trying to short that resistance, and then they get taken out, they're manipulated, so now they're shorting to the downside, and the liquidity available here is now the reason, or is now all up for grabs once we have that break of structure to the upside. So it's now the reason that price shoots to the upside, and we see those large moves following. I did hope that makes sense, but I'll show you guys with some candlesticks as well when we get into it. But liquidity concepts are going to be very, very, very important for institutional analysis in general, and just looking for high value areas, high value zones, because you can have a really nice demand zone, something that looks good, right? Something like this that's within premium, and then you find another demand zone, right? And you're trying to take it to the upside. But as we know, the market isn't going to give you that easy higher high, higher low behavior where it's just going to continue to the upside like that. We must look for the premium and discount. Now that it's in premium, we're looking for shorts. We get a break of structure to the downside. Here's your impulsive candle. You have supply. You can enter on the supply, take it into discount, into equal lows. Now that the equal lows have been taken out and the long liquidity has been opened up, everybody's in shorts to the downside. We wait for the break of structure to the upside, because now all the money is on the short side. We get the break. We have our demand zone, and we can look to take it to the upside, with market structure saying higher high, higher low, continuation to the upside, our confirmation once we came back into discount, and then the continuation. So that's really what I'm looking for as far as institutional versus a retail perspective. They are manipulated on scenarios that are simple, something that the 90% of people can look at and be like, hey, that's easy. I could make 5,000 in 5 minutes doing that too. And that's why they are taken out of their trades. And that's why the market moves that the way that it does, because that other 10% that is profitable is manipulating the 90% out of their trades in order to grab more money so they can stack their positions. That's as simple as it is as far as liquidity. But I will bring this into candlesticks as well, and we will understand it from a candlestick perspective with gold specifically. And we'll also talk about session times and how the uninformed liquidity can be taken out with their session times. So all very, very important, because price is both manipulated on time and price. What you see on the screen, how the candlesticks are forming, that's how you are going to be manipulated psychologically when you are looking to trade. I'm sure many of you have been through an instance where you have a limit on a certain really good demand zone, and it pops into your demand zone or supply zone, and then it raids you, it takes you out, hits your stop loss, and then it moves in your direction. And you're like, what happened? I got the direction right. Why was I not ready for that? Well, the reasoning for that is the manipulation at your zone was for the ability for new supply or new demand, because new money is coming into the market so we can have a new move. That's why I personally talk about not looking left as much. So I talk about not looking left too much, meaning don't go back too far in time and try to find this perfect zone that you're going to look to trade off of, because I'm always looking for the new demand or the new supply. That's why you'll only see usually 1 or 2 zones on my charts. And let's talk about this on candlesticks as well. So now that we've seen this type of behavior, let's now keep this in mind. Remember what we had just talked about, and we'll go down to gold now, and we'll talk about how that had happened within this area right here. Right is the way. Right is the way. I'm telling you, man. I'm telling you, man. Right is the way. And I'm about to show these people right here, right now. I'll have one zone, right? And let's just talk about our weekly zone right here. I've done quite a bit of analysis on this zone. Most of you should have seen how I had come up with this, but for those who are new or those who are talking about how I was able to come up with this certain zone right here, let's just talk about this behavior here. So gold was in an uptrend. This is a weekly time frame, mind you. We were in an uptrend, making higher highs, higher lows. And then we saw a large move to the downside. Now this induces a lot of shorts. It gets a lot of retail because they see this large black candle to the downside, this large sell candle. They're saying, hey, I'm going to short it when it comes back up into this zone, or whatever they're choosing, right? Because they believe there is resistance at these areas. So they have resistance, they have it out, and they're saying if price comes up into resistance, then I'm going to short it to the downside. But as we can see, they were all longing as well when it was making higher highs and higher lows. How can I see that? The form of trendline liquidity, equal lows that we can see right here. Now your actual swing move was from this low to this high. Price came up into premium, distributed into discount, and then mitigated what started our break of structure to the upside. So overall, we still maintained bullish behavior. We just made a higher low and then continued to the upside from this swing move that we have here. It came down and filled imbalances and then continued to the upside. But from a retail perspective, who said, hey, there's a large move to the downside, I want to catch that top, right? They get that emotion that they're like, I want to catch the top. We're going to take this to 0, take it down to here, whatever they're trying to decide, right? They decide to do that. And what are they going to do when they get in shorts here, 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 and then even up here? Where are they going to set their stop losses like we had talked about? At these highs. They're going to put their stop loss at this high because they don't want to be wrong on direction. That is the highest high that caused this low right here. So now that they do that, and now that that liquidity is available at those highs, because they have placed all of their stop losses over those highs to be able to catch the top, because it's coming up into their box, right? Their resistance zone. They get taken out of their trades, and then price just shoots and it continues to the upside. Now everyone trying to catch a top whenever they see those bear candles is the reason that price continues to the upside. Their stop losses is what price is seeking. The 10% is what the 10% is seeking. So price came down, made the lower low internally, and then it came up. We had a reaccumulation. The reason I can tell this is a reaccumulation is from this consolidation candle here, this doji candle here. This is actually called a dragonfly doji, and the reasoning for that, we have both dragonflies and gravestone dojis. A gravestone doji is this, but flipped, meaning the wick is going to be longer on this side, and you have a short wick on this side with a doji candle. But what this shows is large buyers, meaning price was consolidating within this area, meaning there was probably a liquidity raid within this area just based off of this candle. Now I'm going to show you the daily chart, and we'll look in here and see if there's reaccumulation. There it is. Distribution to then reaccumulation and continuation to the higher upside. Exactly what we saw right here. Played right here. Same exact scenario. We rated lows, came back into discount of this swing move right here, this range right here, and then introduced demand and made that push to the upside. So now everybody again was trying to short at these highs is the reason price goes up. Then they put their stop losses over these highs, and then it continues to the upside and takes out those highs. It's good. It may seem very difficult, but you'll start to see it as very simple when you bring market structure and premium and discount together to understand why manipulation occurred in certain areas. So now that we had found this zone, and now that we have our range as well, our weekly range that we had drawn right here, now that that is feasible, where am I going to look to sell? Within premium, if structure shows the same. And then where am I going to look to buy? Within discount, if structure shows the same. So price came up into premium, and it took out all of these equal highs in the form of trendline liquidity. What is retail doing? Once it retests, buys. Buys to the upside. Right? Stops below the lows, buys to the upside. We'll draw it out like this. They're putting their stops right here. They're putting their stops right here. They're putting their stop losses underneath this low. And then what if they're wrong? What if they're wrong and they're holding? Well, let's put it underneath this low, and this low, and this low, and this low, until what? They're liquidated, until price continues to go opposite of their direction as it has switched in market structure, meaning it came up into premium. We saw price break down to the downside right here. We saw the return to that. It created a lower high. From now, bullish market structure to bearish, lower high, lower low, lower high, lower low. So we're in a bearish order flow while retail is constantly trying to figure out every single zone. Support, right? They see this entire area as support to buy off of, and you can see the reactions to the zones. This is how you know that these concepts stay true to themselves, and the market will continue to show the same thing over and over again. This is a weekly chart from 2020. You can see the same exact thing happen over and over again, and it's been happening for years. This will never change as far as how the market moves. But you get these areas of quote-unquote support and these areas of quote-unquote resistance, right? They see this area as resistance or something similar. So what are they doing? Buying. When it goes to the upside, when it breaks out, they buy, price breaks down. Now that their stop loss is underneath these lows or underneath their zone, breaks down, comes back up, makes a lower high, continues to the downside, introduces supply, comes up to the supply, and then makes its move to the downside. This is how you can start to see that manipulation of liquidity, why it occurs, and then why price moves the way it does into certain areas. Now that we have taken out all of the shorts on this move to the upside and got everybody into buys, price is ready to break down and make its move into discount, now targeting the sell side liquidity. So after the buy side, we targeted the sell side. And then if you were to see the opposite of this occur, meaning it left the highs, left lows and then moved to the downside first and took out the sell side liquidity, then you would wait for your structure shift and now target your buy side liquidity. It's back and forth, buy side, sell side, supply and demand. That's what we're looking for every single time. Definitely. Sounds good, brother. And no problem. But it's literally try to keep it as simple as possible, and that's why I talk about premium and discount as much as I do. Why it's so important is because if you didn't utilize premium and discount, you would just try to find every single equal high or every single equal low and take a trade off of that. And trust me, I've done this as an institutional trader, and that's why I talk about it. Because we want to get into high value zones instead of marking out demand zones here, or here, all of these different zones that are created on these moves. Now I only have one high value area within discount that I'm looking for price to come into after it's made its structural shift. And that's how we were able to catch those 228 to 1 shorts and hold to these areas. Because now you have that availability to have the higher time frame scale, to understand the higher time frame sell side liquidity goal, and to hold into those lows, even though retail is trying to buy, because they see what? Support, demand, right? They try to find demand within these wicks. They do all this work to try to will something into their direction, and then they are stopped out of their trades. But that's as simple as it is as far as liquidity concepts, how they start to work and how they present themselves. Now let's talk about how we could enter a trade, because we just talked about liquidity, right? So we're going to use a lower time frame example of XAU down here at these lows to talk about that same exact behavior. All right, so we understand we're in a bearish market structure, but let's talk about what had happened over here. So we are within a bearish market structure, and on our 4-hour time frame, or actually our daily time frame, we can go to our daily. Our most recent high that caused this low is here. Why am I calling it here? Because this is that accumulation to distribution that started the impulsive move, that broke structure to the downside, that broke this zone and broke this internal low that caused a new internal high right here. So we can go ahead and bring this to here. But if you notice, all of these supply zones that I'm choosing are at zones of demand that have been invalidated, right just before. This is how you will start to see how the supply and demand works together. So we get that internal move to the upside right here. It breaks internal highs, lower highs that cause lower lows. So we get the internal push to the upside. Now we need to wait for market structure to switch bearish again. Once it switches bearish, you have your area of supply. Candle before, we can see it comes back into that and then makes its move down. And now that it's at this area, retail is saying, hey, this low caused this high. This high is going to get taken out. Higher low, right? And they want to take it to the upside because they want to catch the bottom. When we're watching market structure, we see that it's still bearish. Instead, it made a lower high, and it's continuing to the downside from what it is showing us here. So as it comes to the downside here, what do we have? Equal lows. Here comes the liquidity from retail trying to take this to the upside, what I just showed you. They're trying to predict that higher low, right? So now that they're predicting the higher low, they're putting their stop losses underneath this low right here. We see an accumulation to then distribution, equal highs. Takes out the equal highs, comes up into that area of supply that had broken this low right here. You can see it just like this. Comes up into that area of supply that had broken that low. It takes out the early shorts, which are the equal highs, meaning liquidity is now available for the algorithms to enter their short positions and push price to the downside. They have the reason to go to the downside, and they now have the availability to go to the downside once price has been manipulated, taking people out of those short trades, because retail is looking at this again like a higher low, and maybe they have something like this drawn out. Trend line broken out. They're like, I'm going to take it to the upside, here it goes. But instead we're seeing lower low, lower high, supply, lower low, lower high, respecting supply, lower low, continuation to the downside. So now we can start to see that in the form of candlesticks. But as we were at this area right here, price continued to make a move to the downside, and then we had a small lower time frame redistribution, and then we saw a push lower into that demand zone. But at this point in time, now that we were within discount, and I'll draw it out like this, actually flip that, we can draw it out just like this. From this high to this low right here, now that we were in discount, we can see we rated the lows and then made a move to the upside. So within this area, within discount, I'm not looking for supply, meaning price was starting to come lower, and then it made a move to the downside, and then we see the move into the zone. You could look at this as that power 3, 1, 2, 3, right? 3 taps into the zone, and then we see that break a structure to the upside from now lower lows and lower highs to higher highs and higher lows. So now that that has occurred and we have broken structure to the upside and introduced demand, I can look for the confirmation of demand and now take price to the upside into an area of supply that had caused this low right here. From discount to now premium, taking out all the equal highs in the form of buy side liquidity. That's the equal highs from retail trying to get into trades here, 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 here. All shorts. Now that the shorts are taken out and we mitigate an area of supply that had previously caused this low here, we see the reaction to it, and then we see the move to the downside, back into discount. Now you can start to see that supply and demand battle from premium to discount and how it works. So I'm going to go ahead and take this off just to make it a little bit more simple. But retail wanted to short, 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 and look at this. What are they doing? Shorting, 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 putting their stop losses over this high, this high, this high. Price makes a move to the upside. They say, oh crap, I'm going to get liquidated. I'll put it over this high, or this high, or this high, because that's the most obvious high to them at this point in time. So then they put it over this one, right? Then they're taken out of their trades. So they're like, oh crap, let me go ahead and buy now because I've been liquidated. I added some more money into my port. Let's just buy. Now that I've been invalidated over and over and over again, stopped out once, twice, 3 times if they're just using these highs right here. And now that they've been stopped out, we see price start to move to the downside. Now that the liquidity has been opened up into the market for them to make that move to the downside because they've been taken out of their shorts and they start to flip long. Well, where's the long liquidity? Right there, we can see it again. The long liquidity buildup within premium. We get an internal structure break to the downside. Price comes back up, makes that lower high, and now it can make the move into discount, targeting equal lows in the form of sell side liquidity, which we can see here. So now you can start to see the battle of liquidity as well as the battle of supply and demand, how it comes together, why it works, and why the market moves the way it does. It's moving against the 90%. The 10% is what is profiting. So the 90% who thinks it's easy and want to short it to the downside, once it breaks that bear flag to the downside, they're going to get manipulated, taken out of their trades, and the market's going to move in the opposite direction. So I personally like to use market structure. I like to use Wyckoff, and I like to use supply and demand for my trade setups as far as what I'm looking for. But we're going to get into gold, a little gold analysis here in a second, but I want to go over to ETH. We are going to talk about Bitcoin and ETH, but that was pretty much what I had for you guys today on manipulation concepts, how you guys are manipulated out of trades based on how the algorithm moves, and then how you would be able to get into trades as well, which is what we're going to talk about here in a second. But let's go ahead and go over to ETH now. Again, same exact scenario here, where they saw that move to the downside. They got their bear flag short. They got the short. So they're all happy, and then they're liquidated out of their trades. They're saying short, 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 short. It broke, and then they're liquidated out of their trades. But let's go ahead and do our analysis. talk about what we're going to talk about, why we're looking for a price to mitigate these areas and possibly make that move to the upside. We've been waiting for a very, very, very long time now. Let's go ahead and draw this out and just see how long since we created this move right here. Roughly 91 days. So yeah, around 3 months that we have been waiting for this coin to show us that hand. I do believe it is very soon. The reason I say this from the 2-day chart perspective is we've came up into this area after we had this liquidity rate to the downside of all of these lows right here. We started to come back up. We could be mitigating areas of supply as well. I do personally believe this is still bearish, not bullish quite yet. For that full pullback, I haven't shown what I need to see on a daily time frame or anything similar to that on a higher time frame, but on our 2-day fair value gap that we have here, as well as zone, you can see that price came down and actually created some more equal lows just right here, just above our zone, which is beautiful. This is exactly what you want to see coming into your zones of demand or zones of supply. And the reason I say this is because now that the uninformed liquidity has decided to long on this zone right here, because maybe they see this low as support, or maybe they have a flip zone, right? Support to resistance, whatever they have, and they're buying off of this zone. They're opening up their limit orders, whatever they had, and they're trying to take this higher to the upside, placing their stop losses under this low here and under this low here. But now we can easily see price do something like this, where it gives them the reaction they want, and then it takes them out of their trades, opens up the liquidity into the market, goes back where the algorithms originally entered their trades, and then makes that move to the upside. Something beautiful, something like this is exactly what I want to see for ETH coming into this zone, this 1151 zone. Perps, I'm not looking at perps. Perps is not the way to go. If you want to find out which or where the coin is, the most data is going to hold on the USDT charts for spot. So if you want to find the most data, definitely go to the spot charts. Perp charts, I used to look at them, but I don't really look at them anymore because personally not trading on Binance either. But for the most data, for the most liquidity, definitely go tap those spot charts. Spot charts are where they're at. So when looking at ETH, we're looking for a move like this, a little reaction off of this lower time frame supply zone right here. I want these highs to be held as well, because that will, again, like we were talking about, give us the reason for price to then target that once it breaks structure to the upside after mitigating our zones and introducing that demand. So if it keeps these highs right here, beautiful. If it does not and instead shows something like this, then I'll be looking more short bias and then something into our area still, again, for those longs overall. But personally, I still see us moving down just a little bit more into this zone, as well as Bitcoin, and we'll go ahead and take a look at Bitcoin as well. But as well as Bitcoin, again, made those equal lows just before our area of interest, which is those 17.5, those monthly equal lows. And we can see we had made an internal structure break to the downside right here. So price could easily be coming up internally to take out some equal highs, and then make its move to the downside into those lows and into our goal. And then we'll wait for a spring type action, which is going to be that break of structure to the upside in the form of displacement, leaving an imbalance behind. And then we'll look for a reaccumulation and for price to start to actually make its move to the upside. Right now, I do believe it's just manipulating a lot of short traders out of trades before it does make that move to the downside. And that's why we saw that liquidation of longs and then that move to the upside directly after, taking out these highs. But this is what I'm looking for pretty much on every single chart as far as liquidity concepts, how they come together, how the charts move, how you see these higher time frame setups to lower time frame setups occur. That's why I look for liquidity to be rated for the introduction of new demand or new supply, because I'm not looking to buy on a quote-unquote support zone or a quote-unquote resistance zone, as I understand those will be manipulated before the actual move occurs. So I did want to talk about XAU as well. I showed you guys this chart before, but we're going to go over to this chart now. and talk about the behavior, what I'm looking for. I actually am looking at a setup right now on the long side for gold, depending on our behavior, meaning right now I was looking at this hourly fair value gap. If we continue to make lower highs and lower lows and leave highs behind after we had this liquidity raid within our POI that we have been talking about, we came back down into discount of this swing move right here, came down into the POI that we are looking for, as well as this one. We did create some equal lows, and we are still bearish, which is why I can't call the bottom quite yet. So we'll have to talk about the behavior right here. Meaning, if price continues to make lower highs and lower lows and grinds down, creating that buy side liquidity we're looking for as it comes into this hourly fair value gap, as well as this 15-minute candle before, we see that break to the upside right here, this 15-minute fair value gap that I have right here after this liquidity raid to the downside. If it shows that quote-unquote creek type of behavior, do I use the 3-tap? Dojang was asking me if I use a 3-tap concept like rec proof when I watch liquidity concepts. I don't use the 3-tap concept. I would say I use it more for I mean, I guess you can call it a 3-tap concept, but like a 3 drives distribution or a 3 drives accumulation. This was a nice little 3 drives right here. You would call them different? You would call them different? I think it's the same. Oh, really? Yeah, up here. Okay. What about like the actual? Yeah, they're nasty, dude. They're nasty. I love them. Um, all right, let's say this. You said the 5, the 15, right here. Yeah, yeah, yeah. Okay, okay. As far as like the whole concept behind it, though, would you say that they're the same as far as liquidity buildup for the reasoning, like to go to the opposite direction? Because that's personally how I see it as. Yes. And this, it has to do something with the psychological number of 3 too. I know that as well. Yeah. Yes. I'm about to show this one right here. This was a little 3 drives into a 50%. This was XAU. But it was into a POI after here. There's an hourly break a structure to the downside with displacement. We left the fair value gap just right there. Had the 50% marked out. I think it was on a 15-minute time frame. Yeah, on a 15-minute time frame here from this low to this high. We came up into that 50%, but the behavior up into it was the most important. And just like we were talking about with that 3 drives, let's just show it right here. Let's bring this back. But as it was coming up into that POI, we saw 1 drive here, 2 drives here, and then that 3rd drive. And what this does is just induce retail to get long positions, long, take it to the upside. Yeah, and hey man, we're all retail. We're all retail. To be honest, at the end of the day, I'm retail. Once I'm a hedge fund, once I can move the markets, then I'll talk that smack. But right now, I'm a retail trader. But looking at this, it just induces people to get in buys, place their stops under each previous low, because like we were talking about before, remember how we didn't have I don't personally look at RSI Dojang for the 3 drive pattern, but it could be similar. I personally don't use many indicators when I'm looking at the charts. I do use session indicators to look at the session times for the ranges. VWAPs, the Mankard ones, the Omni bands too. Come on, man, you already know. But price is pushing up, right? This is getting people out of shorts, taking out the highs, and then on the third push to the upside, we see that distribution that occurs right after. So we look for that type of behavior into our zones of demand or zones of supply. Like we showed that gold long down here on the 4-hour. I have no clue why it's doing this right now. Let's delete this. It's taking all my lines away. But anyway, let's just focus on the candlesticks down here. But as it's coming into the zone, it's inducing people to get into shorts, and you see the 1 tap, you see the 2 taps, and you see the 3rd tap, and this is getting everybody into shorts, placing their stops over the highs like we were showing before, and then it makes that move to the upside. But that same exact behavior was happening over here on a minute time frame too. This is why I like to talk about how price is fractal. You can see the same thing happen on the monthly as the 1 second. It's all the same behavior when price is moving, when it's making that occurrence into certain liquidity areas and supply and demand. But for gold, you were talking about a 12-hour OB algo. This one down here. Okay. Right. Okay. I do honestly think we fill this as well. That's why I'm looking at this structure. It really depends on this move right here. If we start to show that creek and we start to reaccumulate within these areas, then I might be looking at a little bit more buy side into maybe these areas and then a continuation to the downside. But instead, I do notice that as well, and I want lower personally, as well as these equal lows that we had formed. So if we just make this move right here, meaning we keep premium of this swing move from this high to this low right here, if we keep that premium and don't hold discount instead, and instead make a move like this, then I'll be looking at shorts into those lows and then into the POI, and then for that final move to the upside after that. So this behavior right here is really important right now. This is what I'm going to be watching tomorrow for possible entries. Entries and exits will be called as far as this certain trade right here. XAU I've been watching the most. This has been my pretty much my child as far as the past couple weeks, past couple months. Been trying to learn her and just getting all that action, understanding gold, how she moves. But she manipulates very, very well, and she loves to manipulate, and that's why I love this certain chart in the way she moves, is because she shows those concepts over and over and over and over again. It's very, very, very apparent. If you tried to just trade gold based off of a quote-unquote simple easy retail type of perspective, then you will get manipulated out of all of your trades. I mean, we can look at areas of quote-unquote support, right, where people are trying to buy, and you just see the spikes down into their stop losses as market structure is continuously bearish. But love gold, man. I'm watching this area right now, the 1657.17 area. I think this is the FXCM chart. And I know this wick isn't apparent on other charts as well, like that wick doesn't show on those charts. But we'll watch for that behavior. If it stays in premium, then we'll be looking at shorts into these equal lows that we have formed right here. But if it maintains discount and instead breaks structure to the upside with impulse on the M15 after we come down into these areas of discount, then I'll be looking at higher buys into equal highs, into more premium of this swing move right here, possibly coming back to mitigate supply that had caused this internal low right here. But that's what I'm looking at for XAU. Like I was saying earlier, entries and exits will be posted, as well as I'm going to go ahead and post this on lessons. Of course, IRB, of course, anytime, man. Anytime, man. But as far as the liquidity concepts, I want you guys to keep it as simple as possible. Just understand that the market is moving from buy side to then sell side liquidity. And then if it moves from sell side to then buy side, it's just back and forth. And then you can use market structure as well as supply and demand to then figure out those areas of interest and your premium and discount, so you're not looking at every single demand zone or every single supply zone. So try to keep it as simple as possible. I know it's a lot easier said than done, but if you guys continue to watch this behavior, the way these candlesticks print themselves and start to show their area of interest, right, start to show those hands in the forms of those large structural moves with impulse, then that's when we can look to get into trades after we get those confirmations within our areas of interest. But with that being said, if there is anybody who had any other questions or anything similar, please go ahead and let me know. But I personally don't have anything else today. Dojang, with the whole 3-tap concept and the buildup, I'm just looking at those areas to be manipulated. I want to see that type of behavior into my points of interest to show that liquidity buildup, the reason to move after we get that structural impulse, the reason to continue to the upside or the downside. And then one more question he had was, how do you choose whether equal lows and discard premium to distinguish a retail pattern? So I don't always look at it as a retail pattern. The reason I'm saying it as a retail pattern is just to show those who have maybe just only traded retail patterns that type of manipulation. I usually just look at trend lines or equal highs as my areas of liquidity. So I'll draw a trend line out and say this is all the liquidity that is available. If I was in a long at these areas down here, or even in a long at these areas right here, I would look to target the liquidity within premium. My swing move is here, so my premium liquidity holds at these equal highs here. So here's one area you can look to take profit on, or you can look to take profit on supply or demand, which your supply area is over here as well. Within premium. So I'm only looking for these areas within premium and these areas within discount. Only buying in these areas, selling in these areas. That's pretty much, again, all I had for you guys today. I appreciate you guys popping out. Appreciate you guys listening in and trying to get that analysis, trying to understand how these markets move, why they move, and how you're manipulated out of trades. I do hope this was helpful for those who didn't understand liquidity concepts or what it was or how the market moved. And like I was saying earlier, this is going to be posted to YouTube after we finish up here. So again, I appreciate everybody who had popped out. If you guys have any other questions that I can't get to right now, then I will get to you in chat just directly after. XAU will be posted, as well as Bitcoin and ETH. I did post that earlier. Dojang said, thanks. Of course, brother. Of course, brother. Love it. Love it. Love it. I love how we have a bunch of different people from everywhere around the world too. It's awesome, man. It's awesome. It really is. But again, with that being said, I hope you guys have a great rest of your day and or night. And if you have any other further questions, just let me know. Thanks, guys. Peace out.